So we're going to start by looking at the 2019 accounts rules, but only in a pretty high-level way. We're not going to dwell too much on the detail in every single one, more of a refresher for those who are familiar with it already. We're going to then look at the SRA high-risk areas, so things like residual balances, acting as providing prohibited banking facilities, those sorts of key themes that we've seen emerging over the years through guidance and through actual breaches of the rules. We are then going to look at some of the SRA and ICAW guidance that's aimed at us as reporting accountants, and then that will tie us into the common breaches of the accounts rules. We're over 2 years into the 2019 accounts rules now, and some of the breaches and the patterns of breaches we're seeing emerging are consistent across firms. So we're going to be looking at that. And then we're going to just wrap up by looking at some of those other key compliance questions, some of those other issues that perhaps aren't linked directly to serious breaches of the rules, but I do get asked quite frequently as a reporting accountant, and then some tips on how your clients can be getting ready for the audit, because presumably we're rolling around to that time of year again. What should we consider when we're carrying out our work? Well, it's pretty straightforward, really. When we're carrying out our client file review work and we're looking at the sample of bills, for example, we should be considering how far progressed is the matter. Have they raised a bill right at the beginning of a matter, a day after the engagement terms were signed? Because if so, it indicates they're billing too quickly. Looking out for disbursements during our file reviews as well. Are they billing for disbursements that have not yet been paid? Well, that's okay, as long as you see an invoice that proves it's been incurred. But actually, if we get an invoice that shows that the work was done sometime after they raised their bill, then they may be billing in advance for anticipated disbursements. We should be looking out for office ledger credit balance, because they indicate when they're taking money into the office account for an anticipated disbursement, because those anticipated disbursements don't always hit the ledger as being an amount due, depending on which system they're using. And if in doubt, we should really be asking to see underlying timesheet or work in progress records, just to see what time has been booked on this matter at the point they raise the bill. So it really is an important point. I should stress it's not worth getting bogged down in if we don't think there's an issue. We should only really take those extra review measures if we think that's what they're doing. If we've got no reason to feel that and everything looks fine, then we don't need to look at timesheets for every single bill. It's only where we've got a doubt.